So next, let's break down some of the different types of moving averages. And the first one we're going to talk about is the simple moving average. So there's two common types of moving averages. The first we'll discuss is the simple moving average, or SMA. Simple moving averages are created to take data from a preset period of time and display the average price of the asset during that period of time. As soon as new data is entered, old data is dismissed. This is the basic idea of the moving average that we've been discussing. So let's say you have a 50 period moving average. You're taking the past 50 days of closing prices, you're adding them up, dividing by 50, and it's plotted on the chart. The good thing is that we don't have to do the math on that, right? We could just add the indicator and it automatically comes up for us, right? We can change the settings, so whether we want 50 period, maybe we want 25, maybe we want 20, maybe we want 100, maybe we want 75, maybe you want 1,000. It really is up to you and how you set up the indicator itself. Now let's just imagine an example of an SMA based on 10 days worth of data. So the SMA will pull data from the last 10 days of closing prices, which is the price the asset was at the end of the day, and divided by 10. It gets the average of that data. The data set is constantly updated where each day closes. The data only from the most recent 10-day closings is included in the average. Now here's an example of just the 50 period and the 200 period. This is on the Algorand chart. This is the daily chart. Here we see, just similar to what we've been seeing before, this is the basic moving average. It's more specifically called the simple moving average. The short period SMA falls below the longer one. Here we see some sort of downtrend. It confirms the downtrend, if you will. The shorter period SMA, the 50, crosses over the 200 period, and this confirms an uptrend. We'll talk more about moving average crossovers in a little bit. Now, the second type of moving average is the exponential moving average. One of the criticisms of simple moving averages, the first moving average we're talking about, is that it weighs in all the inputted data equally, regardless of how recent or how long ago it was. It doesn't matter if it's on day one or the day before that the yesterday's price data or price data from 50 days ago. It's all added in and it has the same weight on the average. The second type of moving average is the exponential moving average, or the EMA. EMAs are designed to give more value or more weight, more credence to recent data inputs when calculating averages. This makes the EMAs more responsive to sudden price changes and trend reversals compared to SMA. So they give more weight, they factor in more recent price data more so than, let's say, if it's a 50 EMA period, it's going to factor in yesterday's prices, yesterday's candle close, more than 50 days ago. So here's a side-by-side comparison, SMA versus EMA, and this is the SMA 250 and the EMA 250. So the difference really mainly comes down to speed. Because the simple moving average is factoring all the data equally, it's going to move at a slower pace because it's factoring in all the previous price data. So if price was much higher, the SMA, especially larger SMAs, are going to factor in that old price data just as equally as it would factor in the more recent price data. Now, an EMA would react faster because it is created with certain calculations. This is something that you can alter, but even just the base EMAs are fine as well. They are preset with calculations that give more weight or more validity, more credence to the more recent price data. So this has a larger say in the average compared to, let's say, the old price data, as we saw up here. So it's going to factor in that price is going down or price is going up in the immediate term more so than the SMA. It's going to react faster to price change. The price drops. The EMA 250 reacts faster. Here we see the EMA 250 coming down while the SMA is still relatively flat. Now here's an example of comparing a smaller or a shorter time frame moving averages. This is the MA9 close. This is on the Ethereum chart, the 2-hour chart. So here we're seeing moving averages in yellow and the exponential, the EMA, in blue. Particularly here, we're in this uptrend. Let's start from the left side. Prices in an uptrend. They're both moving up. EMA is moving up in blue. The moving average is both moving up in blue. Here we start to see a bit of a divergence, a bit of a disagreement. Moving prices coming down, right? We see these red candles, so a bit of a correction, pullback, and the moving average 9, the yellow, is still moving up at somewhat of a similar rate. EMA 9 in the blue, we start to see a bit of a shift. It's not moving up at the same rate. We're starting to see it's starting to change its slope, if you will, and maybe attempt to flatten out because price is starting to come down. Now, if we take a look here, this is where we have a really clean example. Price came down. Both moving averages are coming down as well. Price is attempting to retrace back up, right? And the EMA blue has shifted. We see a crossover here where EMA 9 comes up and is representing that, hey, there was a shift. Price is coming back up. At the same time, the SMA, or the basic moving average in yellow, still coming down during the same time period. We also see here, this is another example, the EMA is reacting faster to the trend reversal. We saw it here. We're seeing it here as well. Price came down. It's starting to come back up. While the basic moving average, or the simple moving average, is still moving down, we're starting to see the EMA flatten out, representing that, hey, there is a shift in the trend, right? We were coming down. Price is starting to come back up. Well, I'm factoring in this most recent data more so than I'm factoring older data. So now, instead of coming down, it's flattening out, indicating that, hey, there's some sort of shift in the market. Here's another example. This is where price fell below the EMA. So in this example, the EMA is in yellow, but it fell below the EMA, did not fall below the SMA on the uptrend. Generally, we're seeing higher highs, higher lows. And here we see price falls below, and we see the crossover, right? In yellow, we have the EMA in this situation. So now the yellow line, the EMA, is now acting as the level of resistance, slightly below the simple moving average. And we see price comes up, breaks past the EMA, because it's factoring in all this more recent data. It's going to be lower compared to the simple moving average, and that has not yet to be breached. So that's just another way to visualize the differences between these two styles of moving averages. Now, more on utilizing these two different tools. So generally speaking, short-term traders may favor EMAs over SMAs due to EMAs factoring in recent data more than SMAs. It's also important to consider the data size of the moving average. Moving average is based on a 100-day average, will respond much slowly to, or much slower to, current information than a moving average based on a shorter time frame, such as a 10-day average. Now, once again, I would consider utilizing both. Even if you are a long-term trader, if you're some sort of swing trader, or if you're a scalper, you're an intraday trader, one may appeal to you on a personal level, or maybe your trading style, your preference. That's fine. I would not necessarily limit yourself. Oh, I'm only going to use the EMA 9 because I am a scalper, or I'm only going to use the moving average 50 because I swing trade, right? We want to have a broad perspective of the market and be able to utilize these different tools in different situations. Now, in this particular instance, we want to keep in mind the data size. So larger data sets, 100-day, 200-day, they may benefit from long-term investors, benefit long-term traders, as these averages are not likely to be altered due to fluctuations in the market. Smaller data sets, 10-day, 20-day, 50, could be favored by short-term traders, as the averages are more based on more recent data. Now, once again, using a mix of both long-term and short-term moving averages, or EMAs, can give good results. A couple different combinations that you might want to consider: the 50 and the 200 period moving average. I've also found the 8 and the 34 EMAs to be useful as well. Sometimes I'll actually use all four of these. Not often. I typically like to use the moving averages more so, and use other tools for immediate price changes, but the EMAs are useful as well, and they can be used in the same situation, same scenarios that we've spoken about before about moving averages, for trade entries, trend reversals, and overall possible levels of support and resistance.